Hey everyone, this is Jenny from Real Estate English Academy. Today, we're going to talk about the different risk classes involved in commercial real estate investment. I'll give you a general overview and point out some specific terminology that real estate investors use to navigate and talk about their real estate investments. The interplay of risk and return is a fundamental concept in any investment decision. An investment is designed to produce an expected return. Return is the term we use for what an investor gets back on their investment, usually through rental income, capital appreciation, or some combination of the two. The term rental income refers to the rent a landlord receives each month from its tenant. Capital appreciation is what happens when the investment property increases in value. Now, a basic principle of investing is that higher potential returns, or what an investor hopes to get out of or earn from their investment, generally require a higher degree of risk. And each investor needs to define their own appetite for risk, which basically means how much risk they are willing to take. By the same token, every investor has a certain degree of risk tolerance, or the point at which they've reached their limit in terms of risk. Another way of looking at risk tolerance is how much risk an investor is willing to put up with or tolerate. Regardless of the risk tolerance, it's important that investors understand the risk-return dynamics of an investment to make sure that that investment is in line with their objectives. Some useful synonyms for the term objective include goal, target, and aim. Okay, now let's take a look at different risk profiles. Commercial real estate investments are typically categorized into one of the following risk profiles: core, core plus, value add, and opportunistic. Core assets exhibit the lowest risk and the lowest potential return. These assets are suitable for conservative investors. This risk profile typically produces low to moderate capital appreciation in the short term. So, although investors shouldn't expect spectacular returns from core investments, they can expect to see their investment perform, which means it should, over time, bring the investor the return they were hoping for. Core assets usually exhibit high occupancy, strong covenant tenants, long lease terms, 10 plus years, and prime locations. Now let's take a closer look at what that actually means. High occupancy is important because it means that there's very little to no vacancy at the property, so investors won't have to spend their time and energy trying to lease or find a tenant for vacant rental units. Strong covenant tenants have excellent credit scores, which means the chances that they will default or be unable to pay their rent are low. Leases with long terms are also important because a long lease term means that the tenant will be staying at the property for several years, and there won't be a need to invest in renovating or trying to release that space anytime soon. Another benefit of core investments is that financing is easily available under normal market conditions. That means it shouldn't be too difficult for an investor to go to the bank and take out a loan to help them purchase that property. Okay, now let's talk about Core Plus. Core Plus assets have slightly higher risk and offer marginally higher potential return. This slightly higher return may come from the opportunity to increase operating income because a lease is set to expire in the near future, or by filling small vacancies. Even though that means more active management of the property, increasing the operating income of the property will ultimately mean more money in the bank. Investors can expect moderate capital appreciation with core plus assets. As with core assets, financing is widely available under normal market conditions, and the holding period is usually medium to longer term, which means about 7 to 10 years. The term holding period refers to the period of time between when an investor acquires or buys a property and when they dispose of or sell it. Now let's move on to value add. Value add assets exhibit medium to high risk and medium to high expected returns. These assets typically provide the opportunity for improvement, which is where the name of this risk class comes from, as the investor adds value by making those improvements. Occupancy and/or rental rates may be below market level. Another way of saying this is that the property is under rented. Significant capital expenditure, or CAPEX, may be required. CAPEX refers to the money that an investor spends on improvements and other management-related expenses. Value-add properties offer higher capital appreciation potential but lower near-term income security compared to core and core plus investments. It may be more difficult to secure financing due to the higher risk. Holding periods are usually short to medium term, which is about 3 to 7 years. And finally, let's talk about opportunistic investments. Opportunistic assets exhibit the highest risk and the highest return potential. They often require substantial enhancement to generate return. Enhancement in this case is another word investors may use when they talk about improvement to a property. Opportunistic investments may exhibit low or even negative initial yields. Initial yields is a term that you use to describe the initial return that an investor can expect from their investment. Total returns have the potential to be exceptionally high with opportunistic investments, but the associated risks are significant. Financing is often highly dependent on the business plan for the asset and the investor's track record, which basically describes the performance history of that investor. Have you ever made an investment in any of these risk classes? If so, let me know in the comments below. And if you liked this video and want to see more, subscribe to our channel and hit the bell button to turn on notifications. And if you want to test your knowledge of risk classes, click on the link in the video description and take our quiz. See you next time.